You can toe the line when it comes to investing. Choose the stocks you like one by one. Or select Sector SPDR ETFs and add the diversification of an entire sector of the S&P 500, like financial. With liquidity, all-day tradability, and transparency. Ready to add diversification to your equity investments? Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
Do stock market valuations matter? Welcome to Marketplace Minute. I'm Ron DeLegge with ETF Guide. Every day we're barraged with experts telling us the stock market's overvalued. Others say the stock market is undervalued. And we've got all this conflicting data, so who's right? Well, if we take a look at the current PE ratio of the S&P 500, and by the way, the S&P 500 is still trading near all-time highs, but the current PE ratio is around 17.8. Now that's much less compared to the S&P 500's very frothy levels back in March of 2000 when it was around 29. It's also, though, slightly less, that's today's S&P 500 PE ratio, than what it was at in September of 2007. So is it any wonder why experts are telling us that stocks are cheap by historical standards? Well, they are. For the rest of us, there's scant evidence that stock prices in the future will make their move based upon historical valuation. There is no light bulb in the stock market's brain that suddenly triggers a rally because stocks are cheap. Likewise, that same bulb does not exist in the stock market's brain that signals a sell-off because stock market or stocks are expensive. So history, for those of us that still bother with it, tells us that the stock market does not necessarily need to be overvalued to suffer a severe decline. And a perfect example of that was what happened in 2007. At that time, stocks, by historical measures, were cheap. But that didn't stop the stock market, the S&P 500, from declining 50% over the next 18 months. So what are the key takeaways? Well, number one, market valuations do matter, but number two, emotion and psychology, or what technicians call market sentiment, still plays key roles in moving stock prices. This will always be the case so long as the stock market has human participants. So it's also a good reason for those of us that invest to never exclusively use stock market valuations as a basis for investing or not investing. The better technique is to use valuations in conjunction with other key fundamental and technical indicators for a more complete view of the stock market. And that does it for another episode of Marketplace Minute. I'm Ron DeLegge with ETF Guide. Thanks for joining us.